Hey, welcome to The Explainer. Today we're taking a look at a platform called Wint Wealth. It's making a promise that a lot of investors are looking for: higher, stable returns. But the real question is, can it actually deliver on that? Let's dive in and find out.
So, just imagine earning a steady 9 to 12% return on your money every year. Now, in today's market, that sounds, well, almost too good to be true, right?
And that really brings us to the big question. Is that actually a realistic return for something that's supposed to be a fixed income investment? I mean, especially when most of us are used to the much lower rates we get from traditional fixed deposits.
Well, this platform, Wint Wealth, claims it is. Their whole goal is to give regular, everyday investors access to the corporate bond market so they can chase these kinds of returns. So how exactly do they pull this off?
All right, so first things first, let's really break down what Wint Wealth actually is and how the whole thing works.
So right off the bat, Wint Wealth is a SEBI-registered broker. That's a big deal. It's a huge check for legitimacy, and it lets you invest in corporate bonds for as little as 1,000 rupees. But honestly, here's the part that I think is absolutely crucial for your peace of mind. Your bonds are held in your own separate Demat account, not by the platform itself. That means your investments are secure, even if something were to happen to Wint Wealth down the line.
Okay, so let's say you're interested. How do you actually get started? Well, the sign-up process is designed to be super quick and completely digital.
It's basically a one-time KYC, or Know Your Customer process. You'll verify your phone and email, punch in some basic info, and then link your bank account. It uses secure tools like DigiLocker to verify who you are, and then you just wrap it all up with a digital signature. Once that's done, boom, your account is all set up and ready to go.
All right, your account is set up. Now we get to the really important part, actually choosing your investment. And this is where you really need to understand one key factor. Look, the single most critical thing you need to understand here is the credit rating. Just think of it like a report card for a company's financial health. It's a score that tells you how likely they are to pay back their loans. A high rating, like AAA, means the company is considered super safe. A lower rating, well, that means more risk. And this table really lays out the fundamental trade-off in the world of bond investing. It's pretty simple, actually. The safest AAA-rated bonds, they offer lower returns. As you move down that rating scale, the potential return goes up. But, and this is the important part, so does the risk. Remember that 9 to 12% we talked about at the beginning? You're typically going to find that in bonds that carry a little more risk than the absolute top-tier ones. Now, beyond just the credit rating, Wint Wealth gives you a couple of other important things to check for each bond. You'll want to look at the security cover. Basically, are the bonds backed by the company's actual assets? Think of it as collateral. It gives you a claim on those assets if, things go south. You can also dig into the financials, like net worth and profit after tax, to get a better sense of the company's overall health.
Now, aside from just picking individual bonds, Wint Wealth also offers a systematic investment plan, or SIP. But hold on, this isn't your typical mutual fund SIP. It's got a very different strategy behind it.
Really, it all boils down to a choice between control and automation. With the Lumpsum option, you're in the driver's seat. You pick the bonds, you decide when, and you can start small. With the SIP, you're basically handing the keys over to Wint Wealth. Their team builds the portfolio for you, but it does require a higher minimum investment each month. And listen, this is probably the most important thing you need to get about their SIP. The strategy is built to explicitly prioritize getting a higher return over picking the absolute safest bonds. It is, by design, a more aggressive approach to investing in bonds. And to be more specific, the bonds they pick for the SIP portfolio are all in that AA to BBB rating range. What does that mean? It means the top-tier, AAA-rated bonds, the safest of the safe, are intentionally left out of the mix to chase those higher yields. So right there, that tells you the overall risk profile is higher. Okay, so this naturally brings us to the big topic, the risks. Because let's be real, no investment is ever completely risk-free, and with corporate bonds, it's absolutely vital to know the potential downsides. Okay, there are basically three main risks you really need to wrap your head around. First is default risk. The company could just fail to pay you back, and we've seen this happen with major companies before. Second, liquidity risk. Bonds aren't like stocks, You can't just click a button and sell them instantly. It's usually best to plan on holding them until they mature. And finally, there's interest rate risk. If interest rates in the market go up, the value of your bond, which has a lower fixed rate, suddenly becomes less attractive, and its price can fall. So really, after all this, it all boils down to a very personal question for you. For your money,
Is that higher potential return actually worth giving up control and taking on more risk? That's the calculation every single investor has to make for themselves.